All right, hey traders, this is Christian from Hertz Tribeca Trade Group, and going to go over a video of, just how to trade this market right now. Right now, we're seeing just pretty crazy intraday price action, and it's difficult depending on where you choose your entries, where you choose your exits. The tape can be very quick right now. You could get up, to go get your lunch or get a cup of coffee, and all of a sudden the market reverses and your P&L is upside down from where you saw it in a very little amount of time. So I wanted to go over some best practices and just some observations that we continue to see on the tape, right? And these are things that I go over a lot in the Tribeca Trade Group room. So I post a lot of things on Twitter, but there's a lot that you don't see me post in regards to strategy, right? And strategy could make or break. You could have the best looking chart set up in the world. You could be completely a little bit ahead of the curve in terms of finding the trend. But if you don't have the right strategy, and especially using options, right? Options are much trickier than trading stock. They're much more volatile, and they're really going to move around a lot when we've got a tape that we have right now. So if you don't have the strategy down of what you're looking to do, you could have these great charts and great technicals, but you may not be making money based on what you're on what you're doing. So I think it's a good time to to go over this, right? So you could call it a headline driven market. Clearly, I think we're moving a lot on tariff talk. That's the latest, right? But it seems like we've had headlines like this now for a couple of years. Let's be honest, regardless of what your political side you're on, there's definitely a lot of stuff going on. There's been, since Trump has taken office, there's been, I would say, a bit more headlines, and especially that's always the case with a new president. I remember when I was on the trading desk at Merrill Lynch, the first couple of years of Obama in office, whenever he went and spoke, the market would plunge. And that was the first couple of years until the market got a little bit more familiar with him and toned down the rhetoric too. So it happens in the first couple of years of a president. This is a little bit more, is a little different, I would say, from my experience trading institutionally for a long time, that, this is a little bit more, there's a little bit more intraday volatility. There's a little bit more headline risk, right? So let's talk about what we're seeing on an intraday basis, right? So it seems like there's a bit of a pattern that's going on. Rallies are being sold. When we come in and futures are up a little bit, like they were today. Today is what I was going to say Friday. Today is Tuesday, July 3rd. It's the day before. It's the day before the 4th of July, and the markets are closed early. So the markets just closed a little while ago. But a good example, and I'm going to show examples throughout this video, because without examples, you're really just kind of just grasping for straws a little bit. But, just to kind of look at how we're seeing, and especially when you have these long wicks, which you can kind of tell on some of these candles that we have. But, this is just a clear example of we're coming into the day, right? Futures are bid all pre-market long. We get into the open. We had a little bit of a push higher here and failed, but we just could not maintain the bid. And sellers come in. Sellers realizing that we're up 34 basis points. They want to take profits. They see green. They see a little bit of profits on their screens, and they're taking profits. Now, of course, this accelerated to the downside in the last hour, but this has basically been how it's been the last couple weeks, I would say. And same thing with yesterday, right? We come in and we sell off, and we push higher. So there's still the buy the dip mentality, but there's also what's a little bit different is sell the rip, and that's present right now. And if you look at this S&P chart, we're very much trading in a range right now. Every time we seem to get to this 2740 level, the market doesn't want to go higher right now. Does this make sense? Probably. The market, you'll hear this, a lot, right? The market doesn't like uncertainty. There's always uncertainty in the market, but there's different levels of uncertainty. When things are really, at the forefront, such as a trade war, things people don't want to push the market higher. At the same point, they don't want to push the market lower because, there's people want to buy things in this market right now. They just don't want to pay. They just don't want to pay overpriced, or really, they don't want to pay top dollar right now. So there's a couple examples that we're going to get to where in your trading, same thing. You don't have to chase. This is not a market to chase right now. So a couple of the first bullet points that I have here, I think are useful, and then we're going to go into a little bit more of the detail. But by kind of waiting to the end of the day, right? So, if you did your research, or if you're doing research at the market close, or at night, which is what I like to do a lot of times, is I like to pour over some charts, not while the market is open. I like to be prepared for the next day. That's first, again, a lot of this is going to be general points that you could apply in any market, but I think just really hits home in this type of market. But you should, for me, I'm always doing my market research after market hours. I'm never doing market research while the market is open. That's for me to kind of watch the tape, see what they're buying, check out the overall sentiment, watch for intraday moves. But I'm not doing research. I'm doing research after hours. So a lot of times at night, I'll go through and look at the charts and say, oh, this is a good setup. And I think from yesterday, I think everybody started to realize when the market closes on the highs, and we start to turn and go higher, it's, oh yeah, everybody's starting to look at these charts and everything looks great, right? Everything starts to look pretty good. Especially those performers that have been really doing particularly well. IGV is one in particular, right? This is the software ETF, closed on the highs yesterday, on the turn, right? So today, it gave back some of that. So my point is here, unless you're going to take profits on the open of the next day, I don't really see too much of an advantage, even though I like this trade and I like how this is starting to provide some confirmation. The price is now just skirted above the short-term moving averages, and you can look at this in Salesforce too, which is one of my favorites, right? End of day candle, beautiful. This is probably one of the strongest ones. And you can look at this in Zen as well, another application software name. But you're going to get a chance. Instead of buying, the green and at the end of the day, you might as well wait until you've got a better entry price. You could start a position if just to kind of put that in place so that the trade is on your books. But it seems like you are going to get a better shot. So, for example, for Salesforce, right? Look at what Salesforce did today. It did not lose any of the short-term moving averages. It finished down 1.8%. Doesn't today look like much better of an entry price than yesterday? So I think that's pretty. So exercising a bit of patience, but basically waiting to the end of the day, especially on a red day, and also waiting to the waiting to the end of the day, because a lot of times we're getting reversals, and that's the case. Just like if you go back to let's see, what was a particular name today for me. Restoration Hardware, which I think is a little bit of a different. I don't think this is a headline name, but you could see at right around 10, 11 o'clock in the morning, this thing looked like it was going to close in value. It was going to be the first nice green bar in about 2 weeks, and it looked like possibly it's going to catching that support and close in value, which would be a great entry point. However, this thing gave back all the early bid to it. So again, another example of waiting till the end of the day in this market, because you may get a better entry price, or just not even doing anything at all, waiting till you get that final look. And again, this particular point you can make in any type of market. This is a good principle in any type of a market when you don't have such intraday volatility, right? And of course, you could start a position. I will tell you, I started a position today in Restoration Hardware. But am I going to take a full-size trade in this type of market on the first go of it? No way. So, now I've got a trade to kind of manage. But it's not that big of a deal, because you know, it's basically I'm scaling in a bit, and I think giving yourself that opportunity again, just to kind of be patient, sit on your hands, and wait to the end of the day until the picture develops, may be a lot better, right? So same thing. So Restoration Hardware was a good example of that. I think Salesforce was a good example of that too. Not chasing green, even if you go back to Salesforce. I think Salesforce started in the green today. Yeah, it started in the green today, and then completely went down. So, don't buy at the end of the day. Excuse me, don't buy in the beginning of the day. Wait to the end of the day to really establish a position, and also don't buy heavy on a green day. You're going to get another chance. You got another chance. Salesforce down 1.8% today, and still above all the short-term moving averages. So the buy signal is still intact, in my opinion. By the way, this video is just for information purposes. I'm not giving you any advice or recommendations. This is just what I'm doing in my plan and what I think can help. All right. So use the VIX. So for some of those intraday reversals, right? I have on at all times on another. You see me pull it from another screen. I have them always watching the VIX. You know, especially with the higher volatility days, it's a must watch. But even right now, because you could see, you know, what time did this happen? I said around, 11:40 to 11:30. We are seeing reversals in the day. So we may start the day green, but then all of a sudden, once you start to see the VIX start to tick up, that's your cue to do something. It could either be, hey, take your profits on some longs, or it could be, you know, if you don't want to do that, if you want to keep your positions on because you like them or they're longer term positions, buy a little bit of cheap S&P puts. That strategy is really, I think, helping a lot of traders right now. And you can, again, as long as you have this VIX chart up here, the market's not going to sell off without the VIX going up. I would say that's 98% of the time. Once the VIX starts to go up, the market starts to sell off. So as long as you're keeping track. So what we did today is, you know, I sent this out to members today. I said, watch this 1520. If we start to get above 1520, do something. Don't just stare, as they say, don't just stare at your screens. Go ahead and buy S&P puts, take profits in your day trades, do what you need to do. But the market is changing directions. And again, if you look back, this, by the way, is the VXN, which is also, this is the VIX for the Qs. I use both. You know, they're two different things. People think it's just, or sometimes people forget what the VIX does. The VIX is just for the S&P. It's not going to tell you the volatility in the small caps. It's not going to tell you the volatility in the Qs, because all it's measuring is the short-term volatility in the SPX. It's not going to tell you anything else. So I have the VXN here, which you could see is the VIX. I call it the VIX for the Qs, but it's the short-term volatility measure for the Qs. But if you kind of scale back here a bit, you know, same thing yesterday. You know, we started to break down that, you know, we retested a couple times. This is a really nice moving average, as well as the white line. So the purple is the 50, the white is the 200. Notice we tested this a couple times. I think right around the European close. And we went a little bit higher because Europe sold off into the close yesterday. And then that's it. Then we really started to see a sell-off. So once we ducked below with vengeance below that purple line, you know, that was a pretty good. And then further below the 200 was a good signal yesterday. But again, we're seeing this time and time again. I just want to give you another example, right? This was, I think, this was Friday of last week, I believe. You know, VIX trending down all morning long. Then all of a sudden it starts to, you see some green bars develop. You know, and here's basically, if you wanted to buy on the first green bar, you did great, like buying S&P puts. If you waited a little bit further until maybe you saw a moving average crossover in the short-term moving averages, you could have done that there. And even if you waited to the 50, we still certainly saw that. So watch that trend of when it changes, because it is certainly changing, and that is a good way to keep tabs on it, to watch that volatility kind of climb, because and then also kind of helps you because you're watching something different than an equity index or a particular stock. You're watching something that is telling you whether volatility is going up or going down. and you could hedge accordingly using that. So I think that is a really good tip to have right now in this market while we're seeing these intraday reversals, because we are seeing both, right? Going back to my, rallies are being sold and overreactions to the downside are being bought. All right, let me skip the Momo stocks for a minute, but because this is more important. Be extremely disciplined. Again, this goes. This is for use in everyday trading, any day trading, but particularly useful right now. Be extremely disciplined. Have a plan every day. Sometimes it is very difficult for me when I watch the tape. I'm reading the tape all day long. And sometimes, if I don't think about it ahead of time, I may end up taking a little bit more risk than I want to. So you should have that in the back of your mind before the market opens. How much are you adding to your portfolio? Are you reducing your portfolio? Are you swapping names? What are you looking to achieve for the day? You don't want to be caught with, you have X amount of cash on the sidelines and you see a bunch of, interesting trades and you deploy some of that cash. And at the end of the day, the market sells off and you're like, geez, that really wasn't a smart idea. So think it through. Have that plan. That helps me tremendously to think about what I want to get accomplished today. I want to think about what can happen with this overall market, not just individual names. To have that big macro picture first and then to drill down into individual names, I think is a winning formula, right? If you think that the overall tape is going to be a tricky one, and there's going to be a lot of headline risk, or the whole tape is going to be, the overall market is not a place where you want it to be, then really you should not be adding a ton of risk in that environment. So don't get caught up by watching the tape. It's a distraction to watch the tape every day, as I do, and as I post, a plethora of trades during the day. Have that in your mind what you want to accomplish. Is it maybe you just want to take one new trade? You have that capacity for the day, or sometimes you're completely full with risk. You decide you don't want to take any more risk unless you take something off. Okay, so that's a great thing to have. Okay, so I think that's extremely important and should probably be, I don't know, like a different color, because that is big on strategy. Maybe I'll put it something like that. I don't know. It should stand out. So let's do a different. Let's put a different color, maybe red. Let's see how that goes. All right, throw that right in the middle. Okay, so let's talk now. I think we'll tackle the bullet ahead of that. If you're trading momentum stocks, right? I know everybody's watching these, different small cap names, IPO names, these smaller cap China internet names. I've coined it China internets on steroids. IQ, for example. And again, like I said, I'm going to give you examples. I would rather give examples like I did with the Salesforce and what the market is doing. But this morning I put a bunch of alerts on some of these Chinese internet names because there was a reversal in China overnight. The Shanghai and the Hang Seng both rallied into the close, and sometimes that can really lead to a nice day when you see that in Asia overnight. So I set an alert where I thought things would get interesting for Sogo, and I know I'm pronouncing this wrong, but I'm pronouncing it as the symbol, something that I remember. But I think I set an alert right around 1180 today, above the short-term moving averages. Actually, I think I put it around 12, excuse me. So above the short-term moving averages, above these candles. I'm not really interested in this name until it can actually prove to me that it's rebounding, that it's doing something. Same thing with Hua. I set an alert this morning right around, I think, 34.5. And until that alert goes off, I'm not going to watch it. There's no, right now, I can, maybe adjust it in a week if there's different price action, but there's no reason for me to get involved in this name until it does what I want it to do. So IQ. This was the only one where the alert went off. I had an alert at 34. So what did I do? As soon as it hit 34, I bought just 100 shares because, again, you need to wait till the end of the day. Just like I gave the example in Restoration Hardware. This thing climbed on this bar, hit 34. Right? I bought it right around here, 100 shares. Started to go higher. Did not. closed inside into this in the middle of this bar, and then it continued to deteriorate throughout the day. So I only have 100 shares on, and then what I did as well, as soon as I went into that position, I sent this out as an alert on the private Twitter feed. My stop right away. I need to know where my stop is every time. And again, this is trading 101. But every time you get into a position, know where you want to take targets and know where the trade is not going to work for you. I'm on the 1 hour bar. Whoops. So I already established this. Let's see if I can find this here. I don't have it up. I think I put the stop around 32. I'm going from memory, sorry, but I think around $32 is what I said, and I have an alert set on that too. So again, just setting alerts for names that you're not in, where it's going to trigger and set up a long for you. Also, a really good habit, and I don't have this on the sheet, but a really good habit is, because this is, I think, just general, is set an alert every time you entered into a position, right? And you can't watch every single position at all times. So set your limit. It's a soft stop, right? I'm not putting I'm not putting an actual order in. I'm putting an alert in. It's a soft stop, so which is around $32 for me. Then I'm defining my risk, right? I can only lose what, $200 on the trade for 100 shares. All right, so that's my stop for that one, and I'm not going to add to it until it gets firmly, until it closes above the short-term moving averages. So really, going back to, following my own plan, I could have waited to the end, should have waited to the end of the day. But if you're doing it on a small scale, such as buying 100 shares, that's fine. It's basically a starter position. But really, if I was going to establish a big position, I would be waiting to the end of the day. All right, so that's for momentum stocks. Keep those stops tight too. Notice I said, where did I establish this? Did I establish it down here? Nope, I established it really tight. If it's not going to work, I don't want to see it go down to here, because $29 is now a $500 loss. That's too late, even though that's the bottom of value and you have support down here. Still too late. Once it moves down to the 50, that changes the whole context of my trade. It's not a trade versus the 50-day moving average. It's a trade for this to stop right here and go back. So if it breaks down here, that's not the whole idea of the trade. Now you have a completely different trade on your hands from what you originally established. All right, so that's important, especially for these momentum names. They're going to move very fast. Right? Again, you get up, you go get a coffee, and it could already be down to $28. So be very mindful of that. Okay, next, this is a little bit, this is something that I do regularly, but again, more important going back into a headline-driven market. Scaling in and scaling out, right? So not going all in, basically just because you like where the price is. This market is giving you lots of chances to kind of get involved at cheaper prices. So your first entry may not be the best in this market right now, considering literally, I'll use the going to get a cup of coffee example. You could put on a trade and you go get a cup of coffee, and all of a sudden there's something on the tape regarding today. It was Micron, right? Just literally, you walk away, come back, and get a much better entry. Right? So you have to have that dry powder, and if it only ends up being a small trade, that's fine too. I think smaller size should be in here too. That should be another bullet. Trade smaller size than usual. Right? This should make more sense to you, or this should make decent sense to you. And I'll use a VIX chart. Right? When volatility is low, around a 13 or 14, right, the market is not moving as much. When the VIX is closer to, let's say, a 20, which we're not out right now, but once we're around a VIX 20, the market is moving faster. So you don't need the same position size to make the same amount of money. Right? So you could actually be putting on half the size that you were doing in here, but making the same, could be making more money because the market is moving faster and moving in a wider range. Just bigger moves. All right, so that's important to realize what level VIX you're at. Same thing when we were above 20 over here. Much smaller position size needed to make a certain amount of money. So if we're moving around like that, you don't need to keep the same uniform. So if your average price is, I don't know, $5,000 a trade, maybe you want to have your full position size be 2,500 and then scale in. Again, you're dealing with different types of moves. Once you get the VIX, I would say above 15. And then above 20 is another threshold. Different position size, especially in options, right? You already have leverage using options. But once the market starts heading towards a 20 VIX, your P&L will, if you're using the same position size that you use with a VIX of a 20 that you're using at a 13, your P&L is going to swing all over the place. Much, much different. So you have to make an adjustment based on the volatility of the overall market. And you can look at this in terms of single names too. Look at what's called the ATR, average true range. If the average true range is expanding, meaning getting higher, that means that the name is getting more volatile. So you want to make sure that you're accounting for that. If it's getting smaller, then you could do a little bit of a bigger position size because the name is not moving as big as it used to. So that's trade smaller size than usual. Scale in and out. I can give you a good example with these two. Yeah, so I think we already kind of covered scaling in, leaving yourself plenty of dry powder to kind of buy when you do have one of those flush out days. And then scaling out, right? So you could look at the best looking setup in the world. We'll go back to Salesforce, right? They gave a really nice setup, or IGV, or several of these software names that I think are looking pretty good. Don't be afraid. First of all, you should already have this, like I said on the onset of the trade, where you're looking for this thing to get to. But if you have a beautiful day like you had yesterday, I don't know what was CRM up yesterday, 2.5%. Don't be afraid to take some off the table. You have to take targets right now in this market. You can't just leave the trade on and say, I'm going to hold out for a double. That's a recipe for disaster in this market right now with the headline-driven market. When things are a little bit easier, but yeah, it was up 3%. If you were sitting long going into today, Salesforce, and it went up 3% and you're not taking a target, you need to really think about that. Right? Because look at what it did today. Down 1.8% today. Again, the buy signal still is in effect. But you could have taken that trade off or taken a target at the end of the day and put it right back on today. So that's the little bit of fun in this market. You just have to set yourself up. And I know like what everybody wants to do in this market. Sorry. Let me take that back. What everybody wants to do as a trader is ride their winners and, of course, sell your losers quickly, right? Don't let your losers become large. Small losers are fine. Big losers, bad. Ride your winners, right? You read about that just about in every trading book. But it doesn't give you, those trading books do not, are not going to talk about what type of environment that we're currently in. And again, I'm talking about options. Stock is a whole nother game, right? You could sit with stock and you could say, okay, I'm following the trend. No trend is broken. I don't need to take anything off. That's fine. I have one of those portfolios too. And I don't exercise. I don't take things off at the highs if it's a trend portfolio. If we really get extended, I may take a target in that trend portfolio, in the cash portfolio. But in options, right? If you're in, let's say, July, August options, and you're not taking a target on a plus 3% day, that's going to be it's going to be tough considering what we had today, right? Down 1.8%. Let's say your option when you bought it was 70 cents and it goes up to $1.30 $1.10, $1.20, that's a huge profit in, in a day or in a couple days. That's huge. Take some of that off. You could take the whole thing off. That's a huge victory. And then if it went back to, if the option from your original purchase price of, let's say 70, I'm just making these numbers up. If, let's say, your original option price was 70 cents, and today it came all the way back to 85 cents, you could put the thing, if you took a target yesterday at $1.30, going back in at 85 cents is not a bad idea. And something that you could do. All right, so the other one that I have here is don't be greedy. I'll give you another example. Last week, I had on Amazon short put spreads and long call spreads. And it was a $5 wide call spread, right? And I think the price, I think it was 17.05. So if I go to the 5-minute bar, it looked like I was going to have a full winner Friday morning. So this one I did the right thing on. Let's see, today is, what is today? Tuesday. This was Monday. This was Friday, right? So I think I had the 17.10, 17.15 call spread. So here, I'm sitting here, 17.22. This is great. Amazon's off to a good start. I'm above my upper strike. I bought these call spreads, I think, for around $2, or like $1.90, $1.80, something like that. I'm going from memory. They're marking at $3.50, right? And I'm like, oh, how many of you do this, right? You could say it's a $5 wide call spread. I could get the whole $5. It's expiring Friday in a few hours. It's above my upper strike. I could get the whole $5. What a huge winner would that would be. But look at what happened. So I took this thing off. Once I started to see it kind of peel down a little bit, I think I took the thing off for $3.50. And my purchase price around $2. That's a huge winner. It's not a double, but it's still, 75% profit in a couple days? Now, it would have been great to get the whole $5, or I could have been left with nothing, zero. Because of the volatility at the end of the day. So, going back to this, be happy. Do not let yourself, and again, thinking about things ahead of time where you want to take money. If you want to let that last piece run, absolutely, and try to get that $5. But be mindful that, lock some in. Or make sure that you're dealing with the profits at that point. So don't be greedy. So that was, by the way, so what I'm talking about is I was short put spreads and long call spreads. And I'm talking about the long call spread side of the trade, even though I've got put spreads on here, which is wrong. Bulk call spreads. Right? And we have that tendency. I trade a lot of spreads, a lot of times for high price stocks. I will trade spreads and I'm where I'm trying to get, a decent amount. But I think, also thinking about in terms of short put spreads as well is a good example too. Sometimes if you sell premium, let's say it's a $5 wide put spread and you're selling it for, let's say $2 and you're collecting the $2. Sometimes we have the tendency to think, hey, I want to get the whole $2. But if the market sells off, let's say a put spread over here could be marking at 30 cents, right? You sold the put spread for $2 and you're buying it back. You buy it back for 30 or 40 cents. Now, granted, you're leaving some on the table, but that could quickly turn with this volatility. So my point over here, going back to don't be that greedy, right? Selling something at 2 and buying it back for 30 cents is a huge winner. Do not get greedy and try to get the last 30 cents. Unless you're so far out and unless you're so far above your strikes that you're going to need a colossal sell-off for that to happen. And then you should be setting up alerts just so that if something changes and you get close to those strikes. But more often than not, the ones that I have are just, just like Amazon was, $10 ahead of my upper strike, and Amazon can move so quickly that could quickly erase all your gains. We talked about trading smaller size. Trading weeklies. If you're trading weeklies, I know a lot of option traders that they like to day trade using weeklies or the next week's options. This goes for any time you trade weeklies. Only put in what you're willing to risk. Because you could buy a weekly, again, I'll use my coffee example, which I've used 5 times now. You could buy a weekly, like, oh, I'm just going to go fill up my coffee. You could buy a weekly for 60 cents. You walk away, now the market sells off because of some tariff headline, and now you're marking at 10 cents or 20 cents. Right? You just lost all your premium. So be very mindful of, again, also associating what type of volatility there is in the market using the VIX and then scaling appropriately. But again, that's my philosophy all the time with weeklies. Only put in, when you're buying a weekly, you should be fully comfortable with losing all of that premium. Because there is no forgiveness if things go the other way, right? If you're in an option that's 3 or 4 months out, the market sells off, you have forgiveness, right? Your option price is going to go down, but you're not going to lose 70 or 80% of your premium like you would in a weekly, unless something disaster happens where the name gets thumped. Maybe like Micron today. But even so, Micron's move today, I don't think if you were out in September, November options, that sell-off is not going to eat your whole premium. Maybe eat away 10 to 20% of your premium, but not 70%. All right, so then, we talked about all kinds of things, to kind of play defense, which you should always, I'll borrow this from Mr. Paul Tudor Jones, you should always be playing defense. You should always be worried about your risk, especially in options, versus your return. That is the ABCs of trading, right? Again, you can look at Paul Tudor Jones, Google, but I will follow what he says to a T regarding that. What does he say? He always assumes that every position in his book is wrong. But, so now that we covered all of that, take advantage of this volatility too. We're getting some really good opportunities to, if just like, going back to this, again, I like to use real examples. But this may not have been a bad trade for you. Salesforce gets knocked down because all of tech is weak. That's a gift. Now, I don't know what Salesforce is going to do Thursday or Friday when the market reopens, but when it's down 1.8% on no news, you could take advantage and you could do some trades around this volatility by buying something very cheap, using the weeklies or the monthlies to take advantage of the pendulum swing from one end to the end. Again, you look at the overall S&P right now. For now, we're trading in a range. Eventually, we're going to break out of the range. But feel free to kind of play the range until it exists. So sorry, let me go back to the 5-minute. Right? We get up to here, sell, sell, sell. We get down to here, buy, 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 buy. Right? So, there are these turnarounds and you could kind of wait for that. But, these are some really good, day traders love this stuff. As long as you're not married to your positions, you're getting huge volatility to capitalize from. So if you're having a difficulty, like you're not taking advantage of this volatility, maybe you have too many positions on. That's another thing. If your book is full right now and you're busy managing all your existing positions, you probably have too many positions on right now. And I say this all the time in the trading room. If you take off some of your positions, have more cash, sometimes it completely opens up your eyes. You're left to think more objectively about what this market is doing, rather than, when you've got very little cash balance and you've got a lot of positions on, you're sitting there, oh my God, the market has to go my way. Rather than trying to anticipate and thinking about it calmly, which way the market you think is going to head next, and doing your analysis and looking, again, being very objective and kind of taking what's in front of you, rather than staying hooked to, oh, geez, I need the market to do this today, right? So trading less and having less positions on I'll tell you right now, especially in a whipsaw market, will help you a lot. All right, so I think we covered them all. I went a little bit longer than I wanted to, but it's a lot. This is important right now. If you're in this market trading, you know, going back to my red headline, you have to have a plan to deal with this. You don't want to get caught, midday and you're like, oh my God, the market is selling off. Did I know that this was going to happen? What am I going to do? Right? Looking at the VIX and having a plan what you're going to do when the VIX turns, whether it's sell some positions. Also, when the VIX gets to the low end of the scale, what are you going to do? Right? When we do something like this, where did my VIX chart go? Ah, here it is. Right? When we get all the way down here, stretched, what are you going to do? How much further do you think the VIX is going to go down? Maybe on this first green bar. Oh, volatility is changing. What am I going to do? All right, these are important things. All right, guys, thanks for watching the video. Again, this is all stuff that we do a pre-market session to talk about the plan for the day, and we do a midday session as well, where we talk about the trades of the day. We review all the option activity of the day, but strategy is very important, just as I went over in the beginning. So you can go to TribecaTradeGroup.com and you can get yourself a 5-day trial for, or a week. Sorry, I don't even know my special. A week trial for $7.99. Check it out for a week. You're not risking much. All right. Thanks very much for watching and have a great 4th of July.